Bloomberg Audio Studios.
Podcasts, radio, news.
Greetings to our TV and radio audiences worldwide. I'm Mathieu alongside Kailey, Leinz in Washington, D.C., and a pleasure to welcome the chair of the Securities and Exchange Commission, Gary Gensler. Welcome back to our Washington bureau here at Bloomberg. It's good to see you today.
Great to be with both of you.
We're looking forward to a conversation today about the climate disclosure regulations that you're unveiling. I have to ask you first about New York Bancorp with some of the drama that we've seen over this past week amidst filing concerns about commercial real estate fallout. Are you monitoring this? Is there anything you can do to protect investors here?
Well, I think your viewers would understand that in the role I'm in, I'm not going to comment on any one registrant or filer, but many banks are public companies. Mm-hmm. Those banks need to make sure that they make full, fair, and truthful disclosures to the public so that the public can make their investment decisions. I know we're going to be talking about climate, but it turns out it's connected. They need to make those disclosures that investors take investment decisions on, and make sure they have proper controls to make those disclosures. And but I don't have anything more on this one bank.
But just broadly, you're not concerned about systemic risk that might be emanating from commercial real estate?
Again, I'm not going to comment on one bank and so forth, but
broadly speaking.
Broadly, at the SEC, we are always monitoring markets for systemic risk. And the reason is because investors get harmed when one bank or one non-bank, it could be a bank, it could be a hedge fund, that fails and spills out into the market. I've been it ain't my first rodeo. I was even in the Clinton administration when long-term capital management failed. I was in the Obama administration when we were, cleaning up after the 2008 crisis. And it's always the American public, both investors and issuers, that get hurt. So at the SEC, we do monitor for systemic risk in our remit, and then we work with Secretary Yellen and Chair Powell and share our thoughts.
So to return to this question of disclosures, and this gets us to the news out of the SEC today, you have adopted now climate disclosure rules that have been significantly watered down from what was initially proposed. Scope 3 has been removed. For Scope 1 and 2, companies are essentially going to have to decide whether these climate risks are material to them. It's a pretty significant change. Why not repropose it by just adopting it today rather than opening it back up for comment? Have you opened the SEC up to more scrutiny and potentially more litigation that could come from this?
Well, let's just step back for your viewers just for a moment. What we have here is that today, literally hundreds, maybe 1,000 companies already today are making information about climate risk available to their investors. They're often doing it on the internet. There's sustainability reports and so forth. What we did today is we adopted a rule. We hadn't had a rule previously. And we said these disclosures need to be in your filings, in your annual reports, in your registration statements, if material. That's consistent with 5-7 decades of what we do. Materiality is the benchmark. It's investors get to make the investment decision based upon the material disclosures. In this case, climate risk is something investors want to know about. Hundreds of companies are already making such information available, but this will give it more reliability.
What's the cost involved here for companies that will be new to these disclosures? Typically, critics point to red tape beyond the politics here. Red tape and increased costs. You actually have a sense of this already for those that are disclosing, and I suspect from the comments that you received, particularly companies that are just making the threshold. I know you have carve-outs for some smaller publicly traded companies, but what would be the additional cost of this due diligence? Could you put a number on it?
So we lay this all out in this release. It's over 800 pages if you want to have some weekend reading. But we really based cost estimates on what commenters had given us. And you asked, we got 24,000 comments on this. And in terms, it depends on the issuer. If an issuer actually determined that it's not material to their investors, the cost would be probably quite low. But if they determine that, for instance, to inform their investors properly that greenhouse gas emissions are material, then the costs go up. But again, in the release, it was measured from a couple 100,000 per issuer to, I think, upwards to high six figures, but still in the six-figure range per issuer.
But leaving it up to the issuer to decide whether this is material, could this actually result in less disclosure around climate-related risks, not more, to avoid incurring some of those compliance costs?
Well, what's interesting is if you look at the Russell 1000, the top 1,000 companies, some surveys show that already 90% talk about climate somewhere, climate risk, and about 60% put out something about these so-called greenhouse gas emissions. And they're already doing it because investors want to get that information. But again, our history, our remit is about that which is material for investors. And that's what we're doing here. And we're climate risk agnostic. And if more companies make this disclosure or fewer make the disclosure, it's about materiality. But I would say what we did today is important because it will bring some consistency and it's a real rule.
Kailey referenced the potential for legal action here. I suspect that
it's part of our democracy.
Put some time into this, indeed. And obviously, legal challenges are already being planned. There are 9 states being led by West Virginia at this point we've heard about. But I wonder, when you consider this, and you've been down this road before, is it governments? Is it corporations? Is it environmentalists who will bring the legal challenges to the SEC, or it is all of them?
I think that at the SEC, we endeavor to do things within the law and how the courts interpret the law. And so we take the economics into consideration. We take these 24,000 comments into consideration. And, of course, we take in another law that's not the securities law called the Administrative Procedures Act, how we do rule writing. I feel quite confident that we've done something within the congressional mandate. And why is that? It's because we're a disclosure agency, and that's all we're doing here. Companies already, 1,000+ companies are already putting out some climate risk information. Investors are already making decisions, and we're saying grounded in materiality, put it in your filings, and be consistent with what you're doing.
On the subject of consistency, though, if you're a big multinational company, the SEC rules are now what they are. California's rules, Europe's rules are significantly stricter. How is this supposed to work if you have to answer to multiple jurisdictions?
Kailey, it's a very good question. They have different authorities. We're a securities regulator. Europe passes a law through their European Parliament that had a goal to manage the environment. California, similarly, through their legislation. That's not what we do. We stay within our chalk lines, if I can use tennis.
Staying within the SEC's chalk lines, despite conversations that you're having today around climate risk, you also, I'm sure, as a 5-member commission and as the staff are going to be considering in recent months, because you are facing a deadline coming up in May around a spot Ethereum ETF.
It is, Kailey. You had to get your crypto question in. I do have to ask this question.
Of course, we are now about 2 months into a world in which spot Bitcoin products exist. They have had incredible demand, more than $8 billion in inflows. Now the optimism is Ether spot ETFs are next. Do you not first have to settle the question as to whether Ether is a security or a commodity? Can you answer that first?
Well, Kailey, again, on any one of these crypto tokens, it's about the facts and circumstances as to whether the investing public is anticipating a profit based on the efforts of others. But we do have filings in front of us. I'm not going to comment. I will say this is a highly speculative asset class. One could just look at the volatility of Bitcoin in the last few days. And look, I grew up loving roller coasters. Maybe in my adult years I don't ride them as much, but you really should be conscious as the investing public that this is a bit of a roller coaster ride on these volatile assets. And then the question is how firm is the foundation of the, you get to the top of that hill, how's the foundation underneath it? And are there cash flows, or what's the use case? For thousands of these tokens, there's about 15 or 20,000 of them. They also may be securities because the investing public is relying on the efforts of some group of entrepreneurs in the middle of these projects.
And would you consider Ether as part of that group that may be securities?
I understand you're asking the question, but again, I'm going to defer on that question.
All right. SEC Chairman Gary Gensler, thank you so much, as always, for giving Bloomberg Television and Radio your time.